The volatility index. All right, so the VIX. This is a really good tool for any investor. The VIX is a volatility index, which is calculated from the implied volatility of the options, including calls and puts, that are in the S&P 500. So the VIX tracks the S&P 500 and how volatile the options of the stocks in the S&P are. So it tracks it for 30 days. And because the VIX is a forward-looking calculation, it is a measure that sees where the market risk is at, and it's also termed the fear gauge because it's seeing how risky the market is depending on volatility. Because volatility is measuring how quickly or how slowly stock prices change. So because the VIX measures volatility, it can be a really good tool for investors to find a good time to buy or a good time to sell. So with what I'm going to go over is what the VIX is, how many volatility indexes there are, and what each of them kind of is in a quick summary. I'm also going to go on some options that you can do on the VIX, which I do, and I'm also going to go over what the VIX is actually good for, just for an individual investor like yourself. Okay, so first, now that we know what the VIX is, there are a lot of volatility indexes. There's the VIX, which is the main one, and it follows the S&P 500. There's also a VIX for the Dow Jones and even the Nasdaq. So it just calculates how volatile that index might be. So we also have a volatility indicator of the VIX itself. So that's a VIX in the VIX. There's also a XIV, which is the inverted VIX. And so what the inverted VIX does is it goes up when the VIX goes down. And when the VIX goes up, the inverted VIX goes down. So there's just a lot of tools measuring volatility, which I'm going to explain why is really good. There's also the short VIX, which is VXST. And instead of 30 days like the normal VIX, it is only for 1 week. Now I'm going to go into the options with the VIX and what I do with the VIX. So you can't buy equity in the VIX, but you can buy options. Now you can buy calls and puts. So what I do is I buy calls. So buying a call in the VIX means you expect it to rise to the strike price or even higher. And this is really difficult to time correctly because the VIX comes in huge spikes very quickly and then it drops down again. So if you don't time it accurately, well, the call option will expire worthless and you'll lose your premium. So what I do is I purchase the calls when they have really low premiums. I won't spend more than $150 on VIX options because $150 is 1% of my portfolio. When the VIX spikes, the call options that I bought for low premiums will be worth more because when the VIX spikes, it's going to be closer to in the money. It's going to be closer to the strike price of the call options. And this causes the premiums in the call options that I purchase to rise in price. And this nets me a profit because now I can sell the call options for a higher premium and I get the net. So this is what I do. It is really risky because you can't time the VIX very accurately. Really, you're betting on if Trump says something or if there's geopolitical tension. So, what is the VIX good for, really? Just for an individual investor who isn't really interested in options in the VIX. So when you see the VIX spike, it's when something happens that causes large volumes of either buying or selling really quickly. We saw the VIX spike in November when the election was around, and this caused the VIX to spike to 22 because there's a huge sell-off of equity. It measures how people are scared in the market, and this can cause volatility, as in the price of stocks, to move very quickly or very slowly. So the VIX is also uncertainty with what could happen, and this could be around the elections or even with Trump's tax reform. So whenever we see something that we don't know what could happen, well, people want to close their positions, realize their gains, realize their losses, and because there's a higher volatility in the market, so now people might be afraid of a stock price moving a lot really quickly. We also see the VIX spike when geopolitical tensions rise. And for example, this month's VIX spike was contributed to the tensions in North Korea. So we saw the VIX go up a lot because we didn't know what happened. So it was uncertainty with what could happen around the world, and so people didn't want to be a part of that. So they sold. This caused the stock's price to move drastically, which is volatility, and this is what the VIX measures. So that was a quick rundown on the VIX. The VIX is just another tool for investors to use to gauge when the best time to buy is or even sell is, and it can also be used to gauge where the market is going or what the current mood is in the market. So that was the video. I hope you like it. Make sure you hit the like button and also subscribe. I'm doing a video this week on a certain stock, so I'm not going to say it yet, but make sure you look out for that. It'll come out this week. And also make sure you look out for the Sunday's video on analysis, because I do analysis of huge companies. I've been mostly doing blue chip companies, and so make sure you look out for that Sunday's video.